Hello, it's Monday the 20th. I'm FxPlew and this is the market brief. So, we've got another banking crisis then, haven't we? Estimates suggest the collapse of Silicon Valley Bank could affect up to 200 firms in the UK tech sector. About 350 UK companies have accounts with the bank, and about 200 of them considered SVB to be their primary financial partner. Back of a fag packet calculation suggests these tech firms have about £2.5 billion of capital tied up in their accounts over there. Ouchies. This saw 140 tech CEOs write a joint letter to the Chancellor over the weekend calling for urgent action. But what's he going to do though? He's already spent one weekend brokering a deal with HSBC, and he had this weekend ruined by Credit Suisse and all the issues over there. You know what they say though, Jeremy, there's no rest for the wicked. But for those of you who like to switch off over the weekend, please forgive the absolute barnstorming bants for the Monday morning, but let me put the weekend developments of this financial crisis in layman's terms for you. Agreement was reached for Credit Suisse to be bought by UBS at a fire sale price, like an 85% discount kind of fire sale price. Now, either this redefines the idea of a cheeky little bid, or more likely the due diligence conducted on Debit Suisse revealed a pretty stinky balance sheet that's yet to be disclosed. Wherever that one ends up, expectation has shifted and the MPC is looking likely to only hike by 25 basis points this month. Although any hike would have no material effect on the current turmoil, it's a little like the black armband for the fallen banks and the associated optics. It's unlikely that any central bank will want to be seen aggressively raising interest rates right now. Over in the US, Powell has come under some pretty aggressive fire. The Democrats have blamed him for unpicking the regulation that had been previously put in place to help ensure that there was a firewall between the collapse of any single financial entity and the rest of the market. The plan was to prevent things escalating to the type of contagion that we saw back in 2008 and the financial crisis there, or, for that matter, what we're going through right now. Once again, in layman's terms, bank CEOs have taken advantage of the looser restrictions and they've loaded up their respective balance sheets with more and more risk, seeking greater and greater profits and shareholder return. But by doing this, they're left overly exposed to the situation that is unfolding now. Double ouchies. Over the weekend, the Fed reached agreement with the Bank of Japan, the Bank of England, the Bank of Canada and the ECB to ensure that there is ample dollar liquidity in the major markets. That means that if a UK borrower needs dollars but faces liquidity issues with their lenders, they can go directly to the Bank of England, who will be able to source supply from the Federal Reserve. Similar to the Bank of England, we expect it's unlikely to see more than 25 basis points from the Fed this week. And there is always the chance that they'll take this opportunity to pause completely. Who would want to say no to a little longer with high inflation when you have a debt mountain the size of the US? In the market, risk appetite was the major driver for the dollar, and safe haven buying drove the dollar index up to about 105.10 last week. We kick off the new week from about 121.80 against the dollar. We're about 114.25 against the euro. And euro dollar is around 106.65 on the open. And for the eagle-eyed amongst you, there's no Bertie this morning. He's in the vets for an operation on his knee, and he's going to be off games for 6 weeks. So you're just stuck with this guy. Sorry about that.
If you do not have a clue, then just tweet through and ask FxPlew.